Hey traders, welcome to Charts and Coffee. Happy Tuesday, everybody. Hope everyone is doing well. We're off to an interesting start to the week. Yesterday, we just got a sample of the kind of unscheduled events that are likely to really plague our price action for at least some time to come. Now, every time we get something new, a new event, a new reaction, a new bit of news, um, the reaction's always going to be greater than when we hear about it again. So as we get through this round of tariffs and then responses from the countries that the U.S. is planning to place tariffs on, this will get to be something that traders and investors sort of say, yeah, seen that, been there, we know what to do. And that's sort of this learning curve. It's almost like a programming that has to happen for a little bit of time. And you'll see subsequent go rounds of this will have lesser and lesser effect. So it's really important right now that when these news bits come out, we pay attention to the response. Now you might say, Rock, how do we do that? How do we pay attention to the response? Or maybe even more specifically, how do we measure it? So I'm going to show you something that we use in the Sector Secrets Mastery, and it's part of my toolkit, and it's something called the daily price movement ranges. And one of the things that was really interesting yesterday with the price action, and I'll show it to you in two ways. It's the same zone. It's the same zone on both the hourly and the daily. And what you'll notice is every one of my charts has the same tools. These are tools that I've been using in some situations for over a decade, in other situations for more than a decade, for more than 2 and 3 decades. The bottom line is when we're looking at a response, it's volatility, right? And with that volatility can come volume, but not always. But there's definitely a volatility response. And the way that we measure volatility as traders has really been, I have found over the years, one of the gaps in most traders' toolboxes. They know there's volatility. We know because the candle might respond quickly or it's larger. But the bottom line is we don't always know how to measure once a dramatic move has happened, if it's done. Have we moved, quote unquote, enough? Yesterday's really dramatic response on the open to the weekend news, the tariffs, and then sort of that quick turnaround we saw about 20 minutes after 10 yesterday, East Coast time, showed us that even in the most dramatic situations, historical volatility is remarkably accurate if we know how to calculate it and apply it. So let me show you what I mean, because yesterday is a really good example of, I like to call it stress testing the indicators, right? If we're in a reasonably simple uptrend or downtrend or whatever, indicators tend to work pretty well. But what about more dramatic action like yesterday's? This is Monday's candle. And you'll see the low here and you'll see the high here. Well, this was the +2 standard deviation of the daily price movement range. And this was the +2 standard deviation on the support side of the daily price movement range. So a lot of drama, but still contained by historical volatility. Yes, we wandered outside what we would typically see, but it was still contained by historical volatility. Now, what about today? So far, again, you can see price action is still very much contained by the historical expectation. If we go back and say, hey, how often do we move X number of points on a particular day? And have we already done some of that? Important to note that we've made already a pretty significant move and we're coming up off of, you can see we're coming up off of that daily price movement range gray support zone. So those are all things that we focus on in terms of the kind of movement that we would calibrate to, having a zone that we would expect could be touched, and then recognizing whether or not we're in an unusual type market where we're exceeding volatility, or is it normal? And normal is definitely something that is easier to trade, right? Normal means that the typical stop loss placement, the typical trigger, they're more likely to hold. When we wander off, into the tall grass, we know that volatility can create far more difficult environments for controlling risk. So measuring volatility is super, super important. And if you don't know how to measure volatility and you've never seen me do this over many, many, many trades, tomorrow I'm going to be talking about how to fix account growth struggles. And one of the many tools that I use, I shouldn't say many, one of really 3, 4 main tools that I use are the daily price movement ranges. And you can see a lot more examples of how they work for me in environments, even like this, when we have a tremendous amount of chop. All right, so those are things to keep in mind. All right, so let's see what else we've got here. So if anyone has any questions, feel free to type them in, and we'll go from there. All right, so this is, by the way, this is the S&P this morning. This is what we've got going on. Already a pretty significant move, so keep that in mind. Another thing to keep in mind about all 4 of the averages right now are they're all below the previous session close. All of them are below the previous session close. And so with that movement below yesterday's cash close, there's going to be a little bit of resistance in that area. So you'll notice around 21,553, I'm going to expect kind of a bearish reaction, bearish sentiment below that level on the Nas. If I take a look at the S&P, that level is, let's type that in. That would be, take a peek. The PSC label that's on the chart, by the way, is what I'm looking at. That's going to be at 60.55. So those are things that we'll be watching as well. We're on the bearish sentiment side of things right now. But I also want to mention that in terms of even yesterday's chop, we haven't even escaped the range that we established. Whether you're looking at the narrower range established at the end of December or this wider range that was established at the beginning of January, we're still in the same range where the low from January 13, and you can see here basically the high from January 24, so basically a 2-week range, we're still stuck there. So one question I ask myself all the time is, are we going anywhere new? Is this a shock greater than anything that we've already been dealing with? And absolutely not. The S&P is still stuck in a very, very well-worn range. All right, so that's what we've got going on here this morning. If you haven't registered for the webinar to see how we look at account growth, whether that be choppy Q1 of 2025 or ridiculously bullish Q1 of 2024, how do we understand what environment we're in so we can use the right tools and the right guidelines, the right setups to take advantage of whatever might be happening. And right now, we're most definitely in some heavy duty chop. All right, a couple other things I want to mention. And if you have any questions, feel free to type them in. All right, so another thing I want to mention is where there might be some interesting action this year. I mean, does it have to be all about the S&P and the NASDAQ and the Mag 7, et cetera? No, I mean, it's a great big playground that we get to play in. And part of that is looking at the playground where the commodities are sitting. And it's really interesting to see where commodities are. What I've got here in this chart are things like natural gas, gold, copper, feeder cattle, live cattle, corn, crude oil, wheat, heating oil, silver. So these are all sorts of different commodities. And I'm looking to see which ones are starting to gain ground. Now, if you're not interested in trading commodity futures, no problem. But think about the stocks and think about the sector ETFs that will key off of individual movement in the commodities. And another thing I would add to that is right now, you'll notice if you take a look at the sectors. So I'm going to jump on over to a different dashboard where we can take a look at the different sectors. And you'll notice up near the top is agribusiness. The ETF is MOO, which is hilarious. It's awesome. And you'll see MOO is way up there. So when I see MOO, agribusiness up there, that's going to direct me to commodities. And that's going to direct me to stocks within that MOO ETF. So there are some interesting things to look at. Throughout this week, we'll take a look at things like commodities like I have just now. We can take a look at currencies, countries, MSCI iShares. And then, of course, earnings season continues to roar on. So we don't want to neglect the spectacle that is earnings. So we'll take a look at some of those things as we go through the week. All right, so let me see what questions that we have right now. And let's see. And good morning to our Simpler Essentials room. First question I'm seeing here is, let's see, Airbnb. Okay, let's take a look at Airbnb. All right. For short into earnings, well, earnings are on the 13th. And if you're looking at, in this case, so what is a pre-earnings play? So let me make it super clear. I don't actually trade the earnings event. I don't hate my money. I'm not looking for a lottery scratch off ticket type mentality. I don't play earnings at all. But to your point, Jess, what about the moves into earnings to the point where I could be flat before the earnings comes out, but I can take advantage of that gearing up, whether that be moving lower or higher. What is that psychology going into earnings? I agree with you as a general rule between now and the release, which again is the 13th, I believe, after the bell. So between now and the 13th, wanting to be flat before earnings actually are released, shorting the rip would make a lot more sense for me. Yeah. So shorting the rip, and it's probably too close. Jess, great question. Is it? You make a good point. It's 9 days out, probably a little too close, but I love where you're thinking. I love where your head's at, because you're asking, hey, what can I do between a certain point and the actual earnings release? And I think if you start 6 weeks out, 4 weeks out, you start looking for where there's some sort of directional clarity, you can take advantage of that into the date of earnings to be flat when that release is out. And yeah, if you started 6 weeks out, 4 weeks out, shorting the rip would continue to be what I'd focus on. But you're right, it's a little too close, because I'm buying puts in a situation like this, and the implied volatility is going to start to increase. I'm with you there. So yeah, great question. And I love how you're thinking about all the little facets of that psychology. As far as DOCU, I'm probably pretty uninterested. Of all the things I could trade right now, Joss, I'm going to continue to focus on overall trends. And I would like to see at least 5 green candles in a row before I start to look at DOCU as something more in a potentially prolonged bullish way. All right. Next up is Dash. DASH. And again, what I'm going to do is look at, is there a trend? And there's one that's trying to form. 2, I'm going to look at how many candles are of a particular color. In this case, we have plenty of green candles. But in the case of Dash, earnings are on the 11th after the bell. So if looking at Airbnb was too close to earnings for the 14th, this is even less time. So again, it is bullish. I would focus on being bullish into the earnings release. It would be flat when that release is out. So again, be aware of whether the earnings is before the bell or after the bell. If it's before the bell, I want to be out the previous session. If it's after the bell, I typically like to be out by noon of that day. And remember that the entire time inside 1 to 2 weeks to the release, buying calls, buying puts starts getting fairly expensive, because that implied volatility goes higher. But by getting out before the release, taking advantage of the ramp up, or in some cases ramp down into earnings, I'm going to avoid that vol crush scenario. That's really only an issue if we hold a long call or a long put through the earnings event. All right, so yeah, I would look to alongside, but kind of stuck in a range, right? All right, next up is let's see here. GR, yeah, as far as day trading goes, it's 14 after 9. So so the question about day trading is really, I don't know what's going to happen after the bell, right? So I'm not going to make any assessments on what type of day trading, what am I looking at? I won't know till after the bell, because after 9:30, that first 5 to 10 minutes can be really telling about where, at that point, once the cash session is open, what kind of movement we might see. That said, all 4 of the indices are below the previous session close. So, in terms of promising, they're all bearish. I don't know about promising quite yet, right? But they're all more bearish in terms of sentiment. The interesting thing is, probably the most bullish is the S&P, right? Because it did have an uptrend this morning on the 5-minute chart until about 20 minutes after 8. I'm looking at the Palantir CEO. He's clearly trying to get some Einstein vibes of that hair. Interesting. All right. I didn't know what the guy looked like. I'm like, who is this? Who is this dude on TV? All right. Anyway, so yeah, looking forward to the webinar tomorrow. I appreciate that, GR. Is there a weekly price movement range? Dave, no. There are other tools that I like for the weekly time frame, and there's other ways that I can measure what I want to get out of weekly clarity. But no weekly. I've thought about it. We've looked into it, but long ago, it became really apparent that curating the data that I need, needed a lot more testing, because it would be a larger sample size of candles and time than I would want for the daily time frame, which is something we do have daily and hourly. But no, it's still just something that is the back of my mind. But really, I have found having the tools that I have by measuring price and participation and underlying market structure, it's gotten the job done in a way that I don't feel like I have anything lacking. It is always something I would like. This tool is something that is unique to Simpler. It's actually unique to my room. It's something I developed over a decade ago. I started toying with the idea back in 2007. And whether or not it evolves to something longer term has yet to be seen. But I'll tell you this, for weekly purposes, and by the way, those of you that are members of the Sector Secrets Master, we have our weekly position trading portfolio session at 3 p.m. Eastern. And I'll get into more of it then. But I really, right now, look at the charts in the weekly, and I don't see that there's something lacking in the information that I need to make a confident decision about putting capital to work. So it's just kind of something on the back burner. And I kind of give you a little bit of that background, Dave, mainly because, anytime I want to put something on a chart, sometimes it's just curiosity, right? And other times it's necessity. And I just, right now, the weekly conversation is really more a curiosity than a necessity. And when something turns into a necessity, it's a whole other different focus. And we have to be really frank with ourselves to differentiate between whether something's sort of a necessity indicator, like daily price movement ranges, hourly price movement ranges, multi-structure, color-coded candles. Those are necessities for me versus curiosities. But sometimes it's those cool curiosities that can lead to, wow, I never thought that this could be such a needle mover. So I'm toying with it all the time. All right. May asks about gold. Yeah, we continue to have a long position in the Sector Secrets Mastery in GLD calls. I'm not interested in gold today. We're already long gold from days ago. And this means that at this point, we've scaled out twice. We still have anywhere from, in the case of our February 14 expiration, 10 days. Obviously, in the case of the February 21, we have much more. But ultimately, whether it's 10 or 17 days to expiration, gold continues to be a symbol that I want to continue to buy on dips for swings. And B, it's always going to be something I'm going to look at for day trade. So it depends on what kind of trade we're looking at. Am I looking for a really short-term today trade or a day trade on a 5-minute chart? Am I looking for a longer-term trend follow? Gold futures are in a trend. That would be on the daily. I would favor the longer-term trend follow. So more candles that trade down into the gray zone of that daily price movement range on the daily time frame, I would be willing to continue to look for long positions. As far as MDLZ, so Commodities, I would only look to long puts as a swing here. So this would be bearish. And then, obviously respecting earnings that are going to be out after the bell today, I would leave Mondelez alone. I'm not going to play earnings, gang. So if something is immediately upon earnings like this, I'm not going to trade earnings. I'm not going to trade the event, gang. And there's not enough time between now and the close to do anything with MDLZ. All right, AMD, last question for the morning. Semiconductors continue to be very laggy. I'm not really interested in semis, and I'm not interested in buying anything that's got consistent red candles like we do on the daily time frame of AMD. If there's anything to do, it would be long puts. All right. If you want to learn more about, okay, Rog, long calls, long puts, that's all you do in your trading account? Yeah, that's all I do. No pattern day trading rule limitations, simple, easy to execute directional trades, and having the confidence to know which direction I'm going to trade in come down to really 2 or 3 tools. So if you're interested in understanding how to simplify your trading and make that the path to your account growth, register for the webinar tomorrow. You'll learn a lot. I'm going to get into expiration dates, understanding structure, how I automate tools for greater accuracy and for, frankly, accuracy and speed, and also removing emotion. That's a key part of it. So we'll get into all that tomorrow. You can register at simplertrading.com/consistency. I'll also be sharing with you almost a year and a half of TradeViz results and how we've been growing an account through the last 16, 17, 18 months, and what kind of trades are we putting on. All right, gang. In the meantime, we're going to have, again, a lot of unscheduled events. Be careful, be cautious. If you don't want to deal with the day trading volatility of unscheduled events hitting your trade, lengthen the time frame out. Some of the best shock absorption can be on longer term time frames where intraday volatility is just absorbed in that price movement range. Be good to each other, gang. I will talk with you soon.